Alicia, what are we expecting in a very short amount of time?
Yeah, so this is a really key number and the last piece of the data puzzle, if you like, ahead of the RBA's first meeting for the year. It doesn't meet in January. And a lot of economists, markets and home borrowers are hanging on this number because it could determine whether or not the RBA cuts interest rates for the first time since November 2023. Interest rates, of course, sitting at 4.35%. We are anticipating the market consensus forecast is for the RBA's preferred measure to see inflation fall from 3.5% over the year to December to 3.3%. The quarterly reading is expected to be 0.6%. The reason we focus on these numbers is because the RBA's most recent forecast for that particular figure is for a 0.7 and a 3.4%. So if we do get these readings, that would be slightly ahead of those forecasts, inflation not as bad as it had earlier predicted, and add weight to the case for interest rates to be cut. But of course, we've got very strong employment market at the moment. The most recent unemployment rate, 4%, much stronger than the RBA had predicted back in November when it made those predictions for inflation. The RBA wants to keep inflation between 2 and 3%, and it really wants to see that inflation is sustainably coming down to that target band, not just that it's getting close, but that it's going to keep moving. So look, markets are expecting around an 60, some measures, 65 to 80% chance that interest rates will be cut. And if we look at these numbers that have just come out, they are in fact even weaker than the market predicted. So for the quarterly measure on the RBA's preferred measure, which is the trimmed mean, we've got 0.5% for the 3 months to December. Now, that brings the trimmed mean inflation rate down from 3.5% in the September quarter to 3.2% now. So that is well ahead of the RBA's forecast. Of course, we typically talk about the headline inflation rate, and that is now sitting at 2.4%, down from 2.8%. So that is in the target band, yep. Definitely. And as I say, that 3.2% underlying measure, the preferred trimmed measure, is down more than the market and the RBA expected. So that's, I suppose, a very early read, certainly adding to the case for a rate cut next month. And as I look at the market moves, the dollar has fallen very quickly on that headline rate. But of course, inflation is a measure of how much we can buy things for. Prices have been very high and inflation has been running very strongly in this economy for a number of years, and it's finally starting to slow, and that is probably good for people who are struggling with the cost of living. And of course, interest rates then becomes the focus. So I'm going to bring in Sherelle Murphy, who is the chief economist at EY Oceania. Sherelle Murphy, what is the inflation data telling us about the state of the Australian economy?
Good morning, Alicia. Well, it's certainly really good news in that data coming under the Reserve Bank's forecast number for the December quarter last year, and also a little bit below what the market had expected, which is why, as you said, the market has reacted, the Australian dollar falling. Now, that, of course, is all now anticipating that the Reserve Bank will have the information that it needs to give it the impetus to put in place a rate cut in February after the February 17 and 18 meeting. I would just warn, of course, this is not the only indicator that matters to the Reserve Bank. Other factors will come into it, including that relatively tight labour market and the risk of inflation from international factors, including, of course, a lot of the geopolitical tension we're seeing and the possibility of blanket tariffs from the Trump administration. But you'd have to say that all up, this is looking really good, and certainly the best indicator we've had so far that the RBA can finally get on with that rate cutting cycle.
And what is your feeling about the appetite the RBA has for a rate cut? But of course, we've seen that very strong jobs market with an unemployment rate of 4%, well ahead of where the RBA was forecasting it would be. And those international factors, is it likely that the RBA is going to come back for its first meeting this year and take that inflation number and cut interest rates? Or is it more likely, in your view, to signal that it will then cut?
Look, this is going to be a very close call, I must admit, Alicia, because simply that inflation number has sort of been is now at the low side of expectations. So that is going to give them a lot of comfort. As you say, the labour market has been stronger. It's not so much the labour market in itself that matters, it's what happens with unit labour costs. So we have to incorporate the productivity element of that as well. And that's been working the other way. So low productivity equals high unit labour costs, and the RBA don't like that. However, when we kind of put the two things together, it's certainly coming out slightly better than the Reserve Bank had hoped. So you've kind of got, a reasonably strong labour market. Wage growth isn't too big, and inflation is finally coming back down convincingly on an underlying basis. So all up, I think it's looking pretty good.
There is an economic concept referred to as the NAIRU, essentially the unemployment rate needed to keep inflation at bay. The RBA has been saying recently that this could be around 4.5%. But of course, wages growth has been slowing and inflation has been coming down. And if it continues to do so with an unemployment rate well below that 4.5%, is it going to have to recalculate that NAIRU?
It certainly would suggest that the NAIRU may be lower than where they thought it was. We will sort of see how this evolves, though, because, as I say, it's not just the wage rate itself, but more those unit labour costs. So the wage rate once you've adjusted for productivity growth in the economy. And that productivity number, as I say, isn't going so well. So, these things have to be considered together. But certainly the Reserve Bank is going to have something to think about in here, in the sense that it's in some ways it's kind of getting better outcomes than thought possible. In other words, a better labour market, stronger employment growth, and yet also seeing inflation fall and not triggering a pickup in wages. Now, of course, as we're talking about, this is all quite backward looking, and the Reserve Bank has to be forward looking in setting monetary policy, because effectively it's setting interest rates for some 12 to 18 months down the track. So if in those calculations, if in its analysis, it is a little concerned that we're not past that danger point yet, if you like, with wage inflation, then it may see these numbers slightly differently. But as I say, it would be hard pressed, I think, to look past this great inflation number, and certainly the markets are telling it that it's time to cut.
Yeah, and conversely, is there a risk that if it doesn't cut now, it could be behind the 8 ball, so to speak, given the lag effect of rates?
There always is, that's right. And it certainly doesn't want to slow the economy any more than it has to, because, of course, the consequence of that could be unemployment rising more than it has to down the track. And that's not desirable either. That is firmly within the Reserve Bank's objectives, is to keep employment as strong and the labour market as full as possible. So, yeah, it doesn't want to do that either. And certainly the Reserve Bank Governor has acknowledged several times that there are a lot of people hurting from these relatively high interest rates at the moment. And so I'm sure if the board collectively think that they can give a little bit of relief, then they're hopefully going to be inclined to do so, as I say, as long as they don't see a threat to inflation down the track.
I'll get your rates outlook in just a second, but on that pain point, obviously we've seen inflation rising since the COVID pandemic, quite a big jump in inflation. Do you think consumers will recover their pre-COVID purchasing power, or is it just that prices are going to stabilise at much higher levels? They
will eventually stabilise, but it's still going to take some time. And that's simply because inflation has been, of course, running much faster than wages over a period of time now. And so there is a gap. There's a cost of living problem, as we all well know about. So it will take time for the gap between wages growth and CPI growth to match back up again to where it was prior to the pandemic. So households are not going to feel instantly better, clearly, when the inflation number falls. It doesn't mean that prices are falling in most categories. Some they are. But it does mean that their wage rate and their inflation rate are more likely to sort of match up again, and they will get some of that purchasing power back. But it will be a slow path, unfortunately. And
very quickly, Sherelle Murphy, I know you don't give specific interest rate forecasts, but what is your outlook for rate cuts in the next 12 months? A lot, a couple, not many? What are you thinking around the rate cut outlook?
Look, we'll obviously have a closer look at these data to see what they're telling us about some of the risks, if they indeed still exist on the horizon with inflation. But it's looking like a year in which we'll see maybe 2 or 3 rate cuts, but possibly not too many more than that. The RBA is dealing with still, an economy which is running, the demand and supply is still fairly close together. It's not like it has to ramp up activity to get things back in line. So I don't think it's going to be a particularly aggressive rate cutting cycle, of course, unless conditions change, particularly internationally. But at the moment, it's looking like we might get maybe 2, 3 rate cuts as the year progresses.
Cheryl Murphy, thank you. And Gemma, as we've been speaking on my Refinitiv data, we have seen the rate cut bets for a February move certainly increased from about 65% on this data set to about 78% now, and that's mirrored in the market performance. The Australian share market has certainly picked up on hopes we will see a rate cut next month, and at the same time the Australian dollar has fallen as it typically does in line with a potential cut, now sitting at 62.25 US cents, down from 62.5 before we got that data.
Thank you, Alicia. We're going to get some political analysis on this now. Tom Crowley is at Parliament House in Canberra. Tom, what are the political implications for the federal government following the release of this data?
Well, Gemma, I can sum it up in one word: jubilation. That's what Jim Chalmers will be feeling. There is no doubt that this is the kind of number that they wanted, 3.2 for that underlying inflation. As you heard, it's on the lower side of what not only the Reserve Bank but the private sector economists were thinking, and it means that February meeting, the all-important February meeting for the federal government, they don't really so much care at the moment about how many rate cuts we might get this year. They just want one before that federal election. It now looks like a live possibility, either at the February meeting or the April meeting. Those are the two meetings, the two chances the Reserve Bank has to deliver what may be some political salvation for the Albanese government. We know how much the election narrative will be framed around the idea of whether voters believe the economy is getting better. The coalition will be saying, are you better off now than you were 3 years ago? And even with one rate cut, the answer for a lot of voters will probably still be, well, no, I'm not. The rates are still high. I'm still feeling the pinch. One rate cut's not going to fix all that. But when the Albanese government says, well, do you believe that under us things are heading in the right direction and the next 3 years will be better, it'll be much easier for them to prosecute that argument if voters with mortgages have that one rate cut a tangible difference to their cost of living in the bank. It is not, however, assured, of course, and this is the really tough stuff for a central bank. The hardest decisions that central banks make are when to turn the corner, and we're getting down to that crunch time now. We do have that low inflation number, but that's an inflation number that's backward looking. It's about the end of last year. The Reserve Bank has been saying in the last little while it cares a little bit more about the forward-facing indicators. What do we think is going to happen next in the jobs market? What do we think is going to happen next to household spending? Those are the kinds of things that the Reserve Bank will also be keeping in mind, and it'll go into this February meeting without all of the information there. The big national accounts release that comes in early March, that's after the next meeting. That'll tell us a bit more about household spending. The big, labour force every single month, well, there aren't any more of those before the next meeting either. But if the Reserve Bank wanted to wait until April, it would have 2 more months of the labour force survey to get a clearer picture of exactly how worried it feels it needs to be about the labour market. So the question now for Michelle Bullock and her board is, do they have enough information, and is there enough public and political pressure? Expect Treasurer Jim Chalmers today to get even closer to the line. He's never and will never directly give the Reserve Bank advice and say it's time to cut interest rates, but gee, he's been making it clearer and clearer the last few times he's been before the media that he thinks things are looking good, the progress is good. Expect him to have a big grin on his face today. This is great news. How much pressure will the Reserve Bank feel to move in this February meeting? They have the option clearly now, and I think the licence to do it, but it's not necessarily urgent. And as Sherelle said, it's not a sure thing. Watch also this afternoon for what the coalition's going to say, because again, their economic message is all about Labor having lost control of inflation, Labor not being able to get things back on track. How exactly will Angus Taylor strike the note today when the news, clearly, whichever way you slice it, is good? I mean, housing costs fell by 0.7% in this quarter. That's been the biggest pinch in the cost of living crisis has been housing. It's now moving backwards, moving in exactly the right direction for the government. So fascinating to hear how Jim Chalmers and Angus Taylor will have to adapt their messages this afternoon.
It will be Tom Crowley at Parliament House. Thank you. The head of the United Nations Agency for Palestinians says an impending Israeli ban on its operations could sabotage the ceasefire in Gaza. Our Middle East correspondent Eric Torchek has more.